And Meta Platforms has had a huge year in 2025, with the stock rising roughly 40% year to date. But recently, the stock pulled back a bit after the Q3 earnings release, which makes it an interesting moment for investors. So let's break down the facts: Meta's core business, its financials, AI strategy, Reality Labs, and what's driving this recent dip. Q3 2025 revenue came in at $51.24 billion, up 26% year over year. AP net income was $2.71 billion, down sharply due to a one-time $15.93 billion tax charge. But if you adjust for that, net income would have been around $18.6 billion, more than doubling last year. Free cash flow for the quarter was $10.62 billion, and the company ended September with $44.45 billion in cash and marketable securities. This video is about facts. No hype, no speculation. Remember, this is not financial advice. Meta operates 4 main global platforms: Facebook, Instagram, WhatsApp, and Threads, reaching roughly 3.54 billion daily active people. Advertising drives about 97% of revenue, making it one of the most profitable digital ad ecosystems in the world. Average ad prices are rising while impressions also continue to grow, driving total ad revenue higher. AI tools integrated into ads improve targeting and ROI, allowing marketers to spend more efficiently. Reality Labs and AI infrastructure are strategic investments aimed at long-term growth, though they aren't major profit contributors today. Meta's scale, global reach, and engagement give it a significant competitive advantage over rivals. In Q3 2025, revenue was $51.24 billion, up 26% year over year. Operating income reached about $20.5 billion, producing an operating margin of 40%. GAAP net income was $2.71 billion, largely due to the one-time tax charge. Adjusted net income, which excludes that tax impact, would have been around $18.64 billion, a massive plus 83% year-over-year growth. Diluted GAAP EPS, $1.05. Adjusted EPS, $7.25. Operating expenses totaled $30.7 billion, up 32% from the previous year, reflecting investments in AI and Reality Labs. Capital expenditures for the quarter, including finance leases, were around $19.4 billion, highlighting how aggressively Meta is investing in its future. Free cash flow came in at $10.62 billion, showing the business still generates significant liquidity. Cash and marketable securities ended the quarter at $44.45 billion, providing a strong balance sheet. During Q3, Meta repurchased around $3.16 billion in shares, with over $21 billion still authorized for buybacks. The company also paid $1.33 billion in dividends and dividend equivalents. Headcount now stands at roughly 78,450 employees, up 8% year over year. These cash flows and buybacks show Meta can reward shareholders even while investing heavily in new growth areas. AI is at the heart of Meta's growth strategy. The company now operates roughly 600,000 NVIDIA H100 GPUs to power its AI models for recommendations, ads, and moderation. Llama 3 launched in 2025, and Llama 4 is already in testing. AI is embedded into Instagram, WhatsApp, Messenger, and Threads, boosting engagement and monetization. Capital expenditures on AI and data centers are substantial, around $19.4 billion in Q3, which pressures margins short term. But these investments are expected to drive efficiency and revenue growth for the coming years. Meta positions itself as a leader in AI, which underpins long-term value. Reality Labs posted $340 million in revenue in Q3, while operating losses were about $4.2 billion. The Quest 4 headset launched in 2025, targeting gaming, enterprise, and mixed reality applications. Reality Labs represents Meta's vision for the next computing platform beyond mobile. Although unprofitable today, it's funded by the highly profitable advertising business. Management considers this a long-term strategic investment, betting on AR/VR as the future of computing. Investors should weigh near-term losses against long-term optionality. The company continues to refine hardware and software to increase adoption. Meta trades at a trailing PE of approximately 24 to 25 and a forward PE of approximately 21, based on adjusted earnings. Free cash flow yield is around 4.5%, and return on equity is above 30%. Analysts forecast EPS growth of 18 to 20% in 2026, reflecting continuing ad growth and AI efficiency gains. Revenue guidance for Q4 2025 is $56 to $59 billion, showing continued growth. Compared to peers like Microsoft and Alphabet, Meta appears attractively valued given its growth and profitability. Despite the short term dip, the company maintains strong financial metrics and shareholder friendly buyback programs. Margins are expected to improve as AI efficiency continues to scale. The stock fell roughly 8 to 10% after earnings, mainly due to higher spending on AI infrastructure and Reality Labs losses. Revenue growth and user engagement remain strong, so the core business is not slowing down. Analysts largely kept buy ratings, but some lowered short term price targets due to capital expenditure concerns. The dip is a short term market reaction, not a fundamental weakness. Long term investors should focus on adjusted earnings and free cash flow trends. Buying during dips could be an opportunity for those confident in Meta's execution and AI strategy. Overall, the fundamentals remain solid despite this small correction. All right, let's take a step back and talk about the key risks investors need to keep in mind when looking at Meta. First, Reality Labs continues to post significant losses. While it's a long-term bet on the next computing platform, these losses are real and affect margins today. Second, Meta is spending heavily on AI and building out massive data center infrastructure. This capital expenditure, while strategic, puts short-term pressure on profitability. Regulatory risk is another big factor. The EU and US are both watching Meta closely, and any new restrictions on data, privacy, or ad targeting could impact growth. Competition is fierce. TikTok, YouTube Shorts, and other emerging platforms are taking attention away from Meta's apps, especially in younger demographics. Macro factors also matter. Advertising is cyclical, and any slowdown in ad spend globally could impact revenue. Finally, there's execution risk. AI and new products are only valuable if Meta can monetize them efficiently. So while the fundamentals are strong, these risks are real and worth monitoring carefully. Now, to wrap things up, let's summarize what we've learned about Meta. The company has strong fundamentals, revenue growth, massive daily active users, and a healthy cash position. The recent dip in stock price isn't because demand is weak. It's mainly due to higher spending on AI and Reality Labs. This makes it more of a sentiment-driven pullback rather than a fundamental problem. Adjusted earnings are impressive, showing around 83% growth year over year, which is a strong indicator of the underlying business strength. Looking ahead, Meta's investments in AI and Reality Labs could unlock significant long-term optionality, even if they pressure margins in the short term. Free cash flow and share buybacks provide support to the stock, and valuation appears attractive relative to peers. Remember, this isn't financial advice. It's important to do your own research, understand the risks, and think about your time horizon before making any decisions. But from a factual standpoint, Meta's fundamentals and growth story remain compelling, especially if you're looking at a 12 to 24 month horizon.